All right, ready to dive deep? Today, we're cracking open The Psychology of Money by Morgan Housel.
Awesome.
And just so you know, this isn't your typical get-rich-quick finance book.
Nope.
Housel goes way beyond just like stock tips and tricks and all that stuff.
Yeah, he dives into the human side of money,
The psychology.
the emotions,
Yeah.
the biases, the things that make us do, well, let's just say interesting things with our money sometimes.
Exactly. Like, have you ever wondered why some folks buy lottery tickets when they can barely make ends meet?
Right.
Or how, like, being super smart, having a high IQ could actually hurt your chances of building wealth.
Yeah, it's fascinating stuff.
It really is. And we're going to uncover all those fascinating psychological quirks. And I guarantee you're going to have a few aha moments along the way. Oh, and get this. We'll even discover what a dentist from the 1930s has to do with all of this.
I love how Houseful weaves in those unexpected stories and historical anecdotes.
Me too. They really make you think.
Okay, so one of the most important points Housel makes is that no one is really crazy when it comes to money.
That's an interesting way to put it.
Right, because we all have these unique experiences that shape our views on money, right? And what might seem illogical to one person could make perfect sense to someone else based on their own background.
Okay, I see what you mean. It's like everyone's looking at money through a different lens.
Exactly. It's like wearing different glasses. And a great example of this is John F. Kennedy. Now, you'd think the President of the United States, he must have a pretty good grasp on economics and history, right?
Yeah, you'd assume so.
But Kennedy himself admitted that he had no real experience with the Great Depression, even though he lived through it.
Wait, what? How is that even possible?
Well, he grew up incredibly wealthy, so that historical event didn't really touch his personal reality until much later.
So even though he was alive during that time, it wasn't part of his personal money story.
Exactly. And that's the point Housel is making. We all have these personal money stories shaped by our families, our communities, the economic events we've lived through. And those stories have a huge impact on how we view and handle money, even more than any textbook knowledge.
So, like, for some people, maybe the Great Recession had a huge impact on their financial outlook. For others, it might have been something like their parents losing their jobs when they were kids, or maybe even winning a chunk of money from the lottery.
Right. All those experiences create our own unique money lens. And it's really hard to understand someone else's financial decisions without understanding those deeply personal experiences.
That's a really good point. It's like, don't judge someone's money choices until you've walked a mile in their financial shoes.
Exactly. Now, ready for another mind-bending concept?
Hit me with it.
Let's talk about enough. You'd think that once you reach a certain level of wealth, you'd be content, right? Like you have everything you could ever want or need.
You'd think so, yeah.
Well, the story of Rajat Gupta really challenges that assumption.
Remind me, who's Rajat Gupta again?
Okay, so this guy was brilliant, like seriously brilliant. CEO of McKinsey, a top consulting firm, a board member at Goldman Sachs, one of the most powerful investment banks in the world. And he was worth an estimated $100 million.
$100 million. Wow.
You'd think he'd have enough by anyone's standards.
You would think so.
But get this, he gets caught up in this insider trading scheme, ends up in prison, loses everything.
Why would he risk all of that?
That's the million-dollar question, right? I mean, it makes you wonder, what drives someone who seemingly has it all to risk it all?
Right. Where's that line where you have enough? And how come some people never seem to find it?
Exactly. And here's where it gets even more interesting. After prison, Gupta actually said something that really struck me. He said, "What does it even matter now? My reputation's ruined, but that only matters if I'm attached to my reputation."
Wow, so it's like his perspective on success and achievement totally shifted after that experience.
Right. And it makes you wonder how much of our drive for more is actually tied to external validation. Like, are we chasing enough for ourselves or for how it makes us look to others?
That's deep. I never thought about it that way.
It's a lot to unpack. And Housel contrasts this with a story about John Bogle, the founder of Vanguard, the investment company.
Oh, yeah, I know Vanguard. They're huge.
Yeah, so Bogle is at this party thrown by a billionaire hedge fund manager, right? And he's chatting with author Joseph Heller.
Catch-22, right. I love that book.
Exactly. So Heller looks around at this lavish party, and he says to Bogle, "I have something this billionaire doesn't. Enough."
Whoa.
Right? It's such a simple but powerful statement.
It really makes you think, what does enough mean for me?
That's the question, isn't it? And it's different for everyone.
Okay, let's shift gears for a minute. I want to talk about compounding. We all hear about how important it is, but sometimes it feels kind of abstract.
Yeah, it can be hard to wrap your head around.
But Housel does an amazing job of illustrating the power of compounding by comparing two investing legends, Warren Buffett and Jim Simons.
Oh yeah, those are some big names in finance.
Right. So Simons, this guy's like a math whiz. He runs a hedge fund called Renaissance Technologies.
I've heard of them. They're
Yeah.
supposed to be like super secretive and successful.
Exactly. And their returns are insane, like it consistently around 66% per year since 1988.
66% per year. That's incredible.
I know, right? But here's the thing, even with those incredible returns, Simons' net worth is actually less than Warren Buffett's.
Wait, what? How is that possible? I thought Buffett was more of a slow and steady investor.
He is. He's averaged about 22% per year.
So how does he end up richer than Simons?
Time. It all boils down to time. Buffett started investing when he was super young, like a teenager. That means his returns have had decades and decades to compound.
Ah, I see. It's like giving your money a head start in the race.
Exactly. So even though Simons has these crazy high returns, he started later, meaning he has fewer years for that compounding magic to work its wonders.
Okay, I'm starting to understand the power of starting early. But how does compounding actually work? I mean, I know it's like interest on interest,
I
but...
know what you mean. It can feel a little abstract.
Right.
Well, Housel uses this brilliant analogy to explain it. He says, imagine an ice age. It starts with just a tiny bit of snow, like a thin layer, surviving in the summer melt. Doesn't seem like much, right?
Not really.
But year after year, that little bit of snow reflects more sunlight, cooling the air just slightly, just enough for more snow to stick around. And then you repeat that process for centuries.
And you end up with a massive ice sheet covering continents.
Exactly. It's mind-blowing, right? And just like that tiny bit of snow, small, consistent investments made early and consistently can create massive results over time thanks to the power of compounding.
So it's like a snowball effect. It just keeps growing and growing.
Exactly. It's like a force of nature, but for your money. And here's the thing. This isn't just some abstract concept. It's how wealth is actually built over the long term.
Okay, I'm getting the picture. Time and consistency are key.
Exactly. And as Hassel points out, sometimes it's not just about making money, but keeping it. Getting wealthy and staying wealthy are two different ballgames.
That's an interesting distinction. I guess it's kind of like it's one thing to win the lottery, but it's another thing to manage that windfall and make it last.
Exactly. And history's full of stories about people who made fortunes and then lost it all. Like Jesse Livermore, have you heard of him?
I'm not sure.
He was this legendary stock trader back in the roaring 20s. He made a killing, especially during the 1929 crash. But guess what?
He lost it all?
Yep. He took huge risks, got overconfident, and ended up losing everything.
Wow, that's a cautionary tale.
It really is. But then you have folks like Warren Buffett and Charlie Munger who managed to not only build wealth, but also hold on to it for decades. What's their secret?
Well, Housel says a big part of it is survival. It's not just about making smart investments. It's about having the discipline and the mental fortitude to withstand those inevitable market storms.
Ah, so it's about weathering the ups and downs without blowing yourself up along the way.
Precisely. And Housel has this great example of another investor, Rick Guerin, who was part of the same circle as Buffett and Munger back in the day.
Oh, interesting.
Yeah, so both Buffett and Munger always believed they'd be wealthy, and they played the long game. But Guerin, he was impatient, wanted to get rich quick, so he leveraged himself heavily.
Leveraged himself. You mean like borrowing money to invest?
Exactly. And it worked great for a while until the market tanked in the 70s.
Ouch, so he lost everything.
Pretty much. It highlights the danger of trying to get rich quick and the importance of having a margin of safety in your investments.
A margin of safety. What does that mean?
It basically means not betting everything you have. It's about having a cushion, a buffer, so that even if things go wrong, you don't lose everything.
So it's kind of like having an emergency fund, but for your investments.
Exactly. And that's a key takeaway for anyone who wants to not only build wealth, but also hold on to it for the long haul. You got to be prepared for those inevitable market downturns and have a plan to navigate them without losing your shirt.
So the big question for our listeners is, are you prepared for those market storms? Do you have that margin of safety built in?
That's a good one to ponder.
All right, now let's talk about something else that's fascinating, and that's why we sometimes believe anything, especially when it comes to financial advice.
Oh, yeah, this is a good one. It's like we're wired to seek out certainty and easy answers, especially when we're feeling anxious or uncertain about our financial future.
Totally. And you know what Housel uses to illustrate this point? The Black Death.
Whoa, the Black Death. That seems kind of out of left field.
I know, right? But it actually makes a lot of sense. Think about it. The Black Death was this incredibly terrifying and unpredictable event. Millions of people were dying, and no one really knew why or how to stop it.
So people were desperate for answers, any answers, to make sense of the chaos.
Exactly. And that desperation led to all sorts of wild theories. People blamed the planets, God's wrath, even specific groups like Jews or foreigners.
It's like when we're faced with something terrifying and unpredictable, our rational minds can kind of go out the window.
Totally. And what's fascinating is that Housel argues we see similar patterns today, even in the seemingly rational world of finance.
Oh, I see what you're getting at.
Right. Like when people are feeling desperate or uncertain about their financial future, they're more likely to latch onto any promise of a quick fix or guaranteed returns.
It's like the financial equivalent of blaming the planets for the Black Death.
Exactly. And it explains why those get-rich-quick schemes and wild market predictions, even the really outlandish ones, continue to find an audience.
Because people are looking for hope, for certainty, for someone to tell them what to do.
Exactly. And that's why it's so important to be skeptical, to question everything, especially when it comes to your hard-earned money.
Couldn't agree more. Critical thinking is essential, especially in the age of information overload.
Do your own research, question assumptions, and remember, if something sounds too good to be true, it probably is. And speaking of too good to be true, what about Bernie Madoff?
Ah, yes. The poster child for financial scams.
Hmm?
The Madoff Ponzi scheme is a perfect example of how a good story can blind people to red flags.
Remind me how that whole thing went down.
Well, Madoff was this Wall Street legend, super charismatic, and he promised consistent, above-average returns year after year.
So people flocked to him, eager to get a piece of the action.
Exactly, and he managed to pull it off for years, attracting billions of dollars from investors, including some very wealthy and sophisticated folks.
But it was all a lie, right?
It was a giant house of cards. He was basically running a pyramid scheme, using money from new investors to pay off older investors, all while skimming millions off the top for himself.
It's insane how he managed to fool so many people for so long.
It really is.
Yeah.
And it highlights the importance of due diligence. Don't let the allure of a compelling story or a charismatic personality cloud your judgment.
So the lesson here is do your homework, ask tough questions, and don't be afraid to walk away if something feels off.
Absolutely. Trust your gut, but back it up with solid research and a healthy dose of skepticism.
Okay, now let's talk about something else that's super relevant, especially in the financial world. Pessimism.
Ah, yes, the allure of doom and gloom.
It's like bad news always grabs more attention than good news. Why is that?
Well, Housel uses this great example from December 2008. The market was already in freefall, and the Wall Street Journal, one of the most respected financial publications, chose to feature a Russian professor predicting the collapse of the U.S. dollar.
Oh, wow.
It's like people were almost eager to embrace the worst-case scenario.
Maybe it's because bad news feels more urgent, more important to pay attention to?
It could be that. We're kind of wired to focus on threats, and a potential financial crisis definitely feels threatening.
That makes sense. But why do you think pessimism, especially about money, holds such a strong appeal?
Well, I think it's partly because bad news often feels more immediate, more concrete than good news. It's that if it bleeds, it leads mentality. A stock market crash makes for a much more dramatic headline than a slow, steady economic recovery.
Right, it's more sensational.
Exactly. And we also tend to overestimate the impact of sudden dramatic events while underestimating the power of slow, gradual progress.
Can you give an example of that?
Sure, think about the decline in heart disease deaths over the past few decades. It's a massive achievement, but it happened gradually through incremental improvements in healthcare and lifestyle choices. It doesn't make for a catchy news story.
Right, it's not as attention-grabbing as, say, a sudden outbreak of some new disease.
Exactly. And the same thing happens in the financial world. We obsess over market crashes, but often miss the bigger picture, the long-term upward trend of the market.
So it's like we're more tuned into the crashes and less aware of the slow, steady climb.
Precisely. And that can lead to some pretty bad financial decisions.
So the lesson here is keep things in perspective. Don't let the doom and gloom headlines cloud your judgment.
Absolutely. Focus on the long-term trends, not the short-term noise.
Speaking of long-term trends, let's talk about volatility. I know a lot of people get freaked out by the ups and downs of the market, but Housel has this interesting way of thinking about it. He says we should think of volatility as a fee, not a fine.
A fee, not a fine. I like that.
Me too. It's a great analogy. He compares it to buying a ticket to Disneyland.
Okay, I'm intrigued. Explain that one.
So you buy a ticket to Disneyland, you pay the fee, right? And you know you're going to have a fun day, but you also know there are going to be some ups and downs throughout the day. Maybe you have to wait in line for a while. Maybe your favorite ride is closed.
Yeah, those little annoyances are just part of the experience.
Exactly. You wouldn't expect a perfectly smooth day, would you?
No, not really.
And it's the same with investing. The ticket price, the fee you pay for the potential for long-term gains is volatility.
So those market ups and downs are just part of the ride.
Exactly. And instead of seeing those drops as punishments, we should see them as the cost of admission to the game.
Like, you wouldn't demand a refund from Disneyland because you had to wait in line for a ride.
Right. So you shouldn't panic and sell all your investments just because the market is having a bad day or week or even month.
It's about accepting those fluctuations as a natural part of the process.
I love that way of thinking about it. It takes the sting out of those market swings. But what about those investors who really can't stomach the roller coaster? What are their options?
Well, Housel acknowledges that not everyone has the same risk tolerance. Some people are fine with lower returns for a smoother ride, and that's perfectly okay.
So it's like you don't have to go to Disneyland if you don't like roller coasters.
Exactly. You can choose to invest in lower risk assets like bonds, or even just keep your money in cash.
So it all comes down to knowing yourself, your risk tolerance, and choosing investments that align with that.
Precisely. But Housel also warns against trying to completely avoid the market's fee, that volatility. He uses the example of Jack Welch, the former CEO of GE.
Oh, yeah, I remember him. He was like a business superstar for a while.
He was, and he was obsessed with smoothing out GE's earnings to meet Wall Street's expectations every quarter.
So he was trying to make the company's performance look more stable than it actually was.
Exactly. He wanted to create this illusion of predictability of control.
But didn't that strategy backfire eventually?
Big time. All that focus on smoothing out the bumps ended up creating a much bigger crash when the company's true financial situation was revealed.
So the lesson there is accept the reality of market volatility. It's part of the game. Trying to avoid it altogether can actually lead to bigger problems down the road.
Exactly. Embrace the ups and downs and focus on the long-term goals.
Okay, I'm getting the hang of this. But now let's talk about something that's super relevant to our lives today: shifting expectations.
Oh yeah, this is a big one. Housel dives into some major societal shifts that have happened over the past few decades, particularly the rise of consumer credit and the growing gap between income growth and lifestyle expectations.
It's like we've become a society that's increasingly comfortable with debt, and at the same time, we're constantly bombarded with images of wealth and affluence.
It's a recipe for financial stress, for sure.
So how does this play out in real life?
Well, Housel uses the example of two fictional characters: Joe, a high-earning investment banker, and Peter, a bank manager with more modest salary. Joe can afford the big house, the fancy cars, the expensive vacations, all that stuff.
Sounds like the picture of success, right?
It does on the surface. But Peter, who grew up in a time when most Americans lived relatively similar lifestyles, feels like he's entitled to that same level of affluence, even though his income doesn't support it.
So his expectations are out of sync with his financial reality.
Exactly. And this, combined with the easy access to credit, can lead to a dangerous cycle of overspending and debt.
I think a lot of people can relate to that. It's easy to get caught up in comparing ourselves to others and feeling like we're falling behind.
Especially in the age of social media, where everyone's showcasing their perfect lives and latest purchases.
Right. So how do we break free from this comparison trap?
Well, Housel challenges us to examine our own spending habits and consider whether they're driven by realistic expectations or by some idealized image of what our lives should look like.
So it's about getting real with ourselves. What truly matters to us? What does enough look like in our own lives?
Exactly. And it's important to remember that true wealth isn't about what you see, the fancy cars and big houses, but what you don't see.
What do you mean?
It's about the money you've saved and invested, the financial security you've built, not the stuff you've accumulated to impress others.
I see. It's like that hidden nature of wealth we talked about earlier. We often judge others based on outward appearances, but real wealth is often built quietly through discipline and smart financial choices.
That's a great way to put it. And it reinforces the idea that anyone can build wealth regardless of their income level. It all starts with making conscious choices about how you use your money.
So we've covered a lot of ground today. We've talked about the psychology behind our money decisions, the importance of understanding our own money stories, the power of compounding, the importance of survival, the dangers of blindly believing anything, the allure of pessimism, and the importance of reframing volatility.
This has been quite a journey.
It really has. And I think it highlights the importance of not just understanding the mechanics of money, but also the psychology behind it.
Absolutely. It's not just about numbers. It's about understanding ourselves, our biases, and the often hidden forces that shape our financial decisions.
And with that understanding, we can make more informed, more rational, and ultimately more successful choices with our money. Okay, so you are going to leave us with a final thought.
Yeah, yeah. Think about all the stories we've talked about today.
Yeah.
Like John F. Kennedy and, how he didn't really experience the Great Depression.
Yeah, because he was so wealthy, it didn't really impact him.
Right. And then Rajat Gupta, all that wealth, and still he wanted more.
It's like, how much is enough?
Right. And, Jesse Livermore, that brilliant trader.
The one who lost it all.
Yeah. And all those people who fell for those financial scams.
It's like we're all searching for that secret formula, that guaranteed path to wealth and happiness.
And it's easy to get caught up in that chase.
Totally.
But here's the thing, we try to be so rational with our money.
Yeah, like spreadsheets and budgets and all that.
Exactly. But the truth is, we're driven by emotions.
Our feelings.
Yeah, and those deep-seated beliefs about money.
Like those subconscious scripts that are running in the background.
It reminds me of that Warren Buffett quote. He said, let me see if I can remember it exactly. He said, "Success in investing doesn't correlate with IQ.
Oh, yeah, I've heard that one.
Once you have ordinary intelligence," he said, "what you need is the temperament to control the urges that get other people into trouble investing."
It's so true. It's not just about being smart. It's about managing your emotions.
Exactly. So self-awareness is key.
Okay, so how do we become more self-aware when it comes to our money?
Well, I think it starts with reflecting on your own psychology of money.
Okay, so like some introspection.
Yeah. Ask yourself, what are your deep-seated beliefs about wealth, about success, about risk?
Like, where did those beliefs come from?
Right. Did you grow up hearing that money is the root of all evil, or that rich people are all greedy?
Oh, I know people who believe that.
Yeah.
Yeah.
And how have your past experiences, shaped your financial decisions today?
That's a good one to think about.
Yeah. And most importantly, ask yourself, are your actions, with your money, are they aligned with your values?
And with your long-term goals.
Exactly.
That's a lot to unpack.
It is. But it's worth it. Because
Okay.
by understanding the psychology of money, we can make choices that lead to true financial well-being.
Well said. And on that note, I want to thank all of our amazing deep divers for joining us on this journey into the world of The Psychology of Money by Morgan Housel.
Yeah. Thanks for listening, everyone.
We hope you found it insightful and maybe even a little bit challenging.
Yeah. Hopefully it'll spark some deeper thinking about your own relationship with money.
And if you want to learn more, we highly recommend checking out the book. It's packed with fascinating insights and stories.
Yeah, it's a real eye-opener.
And until next time, keep diving deep.
Yeah, it's amazing, isn't it, how all this stuff we don't even realize is going on in our heads can have such a huge impact on, how we handle money.
Like a hidden world of money beliefs and emotions.
Yeah, exactly. But for our listeners who are like, okay, this is all very interesting, but what do I do with this information? Where do they even begin to apply all this stuff?
That's a good question. It can feel kind of overwhelming, right? Like, okay, I get it. My psychology affects my money, but now what?
Right, right. So one of the most practical things you can do is figure out your own money script.
Money script.
Yeah, it's like your personal set of beliefs and attitudes about money, the stuff you've picked up over the years.
Like from our families, our culture, all that.
Exactly. And these beliefs can be about, anything related to money, like how you earn it, how you spend it, how you save it, how you invest it.
So it's like a mental framework that shapes how we view money, how we interact with it.
Exactly. And the thing is, most of the time, we're not even aware of these scripts. They're just kind of running in the background, influencing our decisions without us even realizing it.
So how do we become aware of them?
Well, it starts with thinking about your past experiences with money.
Yeah.
Go back to your childhood, your early jobs, any big wins or losses you've had.
Like a financial autobiography.
Yeah, kinda. Ask yourself, what messages did you receive about money growing up? What did your parents teach you? What were their attitudes towards money?
That's a good one. I know my parents were always very careful with money, always stressed about saving.
See, that's part of your money script right there.
Huh.
And then think about, what are your biggest financial fears or anxieties? What keeps you up at night?
Oh, I have plenty of those.
Right, we all do. But by digging into those fears, you can start to understand, what beliefs are driving them.
So it's like doing a deep dive into your own financial psyche.
Exactly. And once you start to understand your money script, you can start to, challenge the beliefs that might be holding you back.
Like if you grew up believing that money is evil or that rich people are all bad, those beliefs might be preventing you from, building wealth yourself.
Exactly. So it's about, recognizing those beliefs and then asking yourself, is this belief really true? Or is it just something I've been carrying around with me since I was a kid?
It's like those limiting beliefs we talked about earlier.
Exactly. And once you identify those beliefs, you can start to reframe them, replace them with more empowering beliefs.
So instead of thinking, I'll never be rich, you could start thinking, I can achieve financial abundance.
Exactly. It's about shifting your mindset from scarcity to abundance.
I like that.
And that's where another key takeaway from Housel comes in, that idea of enough.
Ah, yes, enough. That simple but powerful word.
Yeah, it's so easy to get caught up in that never-ending chase for more, more money, more possessions, more status.
Always wanting the next thing, never feeling satisfied.
Right. But defining what enough means for you, that can be a game changer.
It's about finding that sweet spot where you feel financially secure and content, without constantly striving for more, more, more.
It's about finding that inner peace with your finances.
I love that inner peace with money because let's face it, money can be a huge source of stress and anxiety for a lot of people.
Absolutely. But it doesn't have to be that way. It really comes down to aligning your money with your values.
Making sure your financial choices are reflecting what truly matters to you.
Exactly. So as we wrap up this deep dive into the psychology of money, I think the biggest takeaway is it's not just about the numbers.
It's about the human side of money.
Exactly. It's about understanding yourself, your beliefs, your emotions, and making choices that are aligned with, your values and your goals.
Well said. And on that note, I want to thank all of our amazing deep divers for joining us on this journey.
Yeah, thanks for listening, everyone.
We hope you found it insightful, thought-provoking, and maybe even a little bit inspiring.
And if you want to learn more, definitely check out Morgan Housel's book.
It's a great read.
Yeah, full of amazing stories and insights.
And until next time, keep diving deep.